So getting right into it, we're going to meet our taxpayer. So Jack, taxpayer. His scenario is that he was divorced in 2013, and he's a heavy equipment operator and a mountain bike enthusiast living in Western Colorado, and he's decided to finally face his tax issues, and he's come to you to solve them. He was divorced in 2013 after his wife ran off with a dashing and handsome accountant, and following her leaving, he was depressed, and though he really cared well for his two children, he neglected everything else, and that's including his taxes. So recently, he has a new love interest in his life, local paralegal, and he's very worried his girlfriend's going to find out about his tax issues. So in response to your radio ad, he's come to see you and help to deal with the IRS. They filed liens for the 3 years that he's failed to pay, and he owes them right now roughly about $100,000. And that, of course, includes his tax, penalty, and interest. It's for 3 tax years, 2013, 2014, and 2015. Now, this was caused mostly because he nearly emptied his IRA account in those years. And, of course, that produced a very large amount of tax liability. You've determined that tax liability is unfortunately accurate due to the penalties and taxes on that income. So there's nothing that, as we move forward with this case, that we're thinking is wrong with the tax liability. We're just going to try to figure out how we can move forward since he's unable to pay. In our scenario 2, the liens have already been filed by the IRS for all 3 years. And so this is a total amount that he owes of $100,000, so that's what we are working with. Now, what we're going to go ahead and do is move that into, and what I'm choosing to do in this case is we're putting all this information into a software that's going to help us to basically work with these numbers. So in the case of Jack, taxpayer, we go into Canopy to enter this data, and we create a survey that helps us to gather this data. And the nice thing is it's going to allow us to change information as necessary. So we go in and we have plenty of data. If you're wanting to go and see in the guide that I give you at the end, if you want to look at the case study answers, you're going to see all of the different demographics and the statistics for him. And what I'd recommend is you actually go through and create your own case off of that so you have practice. And that is really the very best way to learn these. There's a ton you're going to learn by watching, but I still recommend you go through and experiment with creating your own offer as well. So in the case of our taxpayer, he rents. He does not own a home. He has 2 children. So in some of this, as we go through, we have entered information about where he lives. We've entered information about his children. And luckily, this is rather intuitive as well, that it would go through and ask more questions depending on how you answer. But just for the ease of this, we're going to say for the time being, he's a single taxpayer. We go through and he doesn't really have much in the way of assets. He does have, he rents, so he doesn't have a home, but he does have a vehicle. And for our purposes, it's a much older vehicle. It has some fair market value to it, but it's an older vehicle with a lot of miles on it. So that's one of the things that we'll be talking about in a moment, if there's anything that can be done with that vehicle. His bank accounts, he has a little bit in some savings, a little bit of some cash on hand, a little bit in his checking account. So at the time being, there's not a lot there, but he does have some stocks worth $2,500. He has a retirement, what's left anyway, of his IRA and his 401k. Roughly half of that is the 401k he has a loan against, but the IRA still has $2,000 available, all that's left now at this point that he's started to rebuild. So this is really the sum of all of his assets. We don't really have life insurance, any lines of credit to speak of. Personal assets, and I do want to just focus on this for a second. As far as our furniture and personal effects, because that's one of the exemptions, you don't have to count amounts that are over that amount. Now, in this case, I've notated them, but they're going to be removed from our 433A because the amount isn't high enough to reach those amounts of exemption. So if it was something that is a valuable item, let's say some sort of a artwork or an antique or collection, those are going to be things that would have to be listed and that we do have to include. But in this case, our taxpayer just has some furniture and personal effects that don't have much of a fair market value, so they aren't going to harm us, but we do want to make sure it's entered in that area so that it doesn't get added into the overall total. Our taxpayer is just a wage earner. There's no business that we have to worry about entering. If there was a business, what we would end up doing is putting that still within the 433A. If it was a sole proprietorship, we would count all the business income and expenses, and then whatever the remaining amount is basically gets added into his overall monthly income. And if there's any assets of any leftover equity, that gets added into his assets. So that's how it would be handled, but for the ease of this illustration, we're going to be going ahead and counting him as just a regular taxpayer. So from here, what we're going to do is we're going to count expenses in a very specified manner, and here's where we want to make sure that we're following those standards. So the rent, $1,100. For ease of this, basically all his utilities are covered under rent, except for cell phone and internet are something we can still count as utility. But remember, I said his standard, $1,673. His expenses only come to $1,450. So even though they would allow more, since he's not spending that much, he gets $1,450. So that's all we get to use in this case. For the food and housekeeping and all of those, just to make it easy in this illustration, we're making it to where he just happens to spend the same amount as what the standard is, because we're going to just show some examples of bigger items here. So $1,378 is what he's spending, but that happens to be his standard. For the healthcare costs, this is actually a unique one because he's spending nothing out of pocket, but he's going to go ahead and be able to use the $49 per person standard times 3 people in his household. And the last one, as we talk about the operating costs, it's an older vehicle. It's costing him a little bit more as time goes on. In this case, he's just going to use the standard amount because the $220 is what he gets. So those are going to be how we work this out on the forms. So all the rest of these items, you'll see it zeros all the way down. The only other thing to mention for our taxpayer is he does have a state liability for his state taxes, and there's very important consideration here. He has an arrangement that's officially set up with his state of $100 a month. So he has an arrangement and he's making the payments. So he's making the payment of $100 a month. That's the only way that you can use it here. So I did want to point that out so that you know how that would work out in the course of an offer. So if we go and look at what this truly looks like, we're going to take a look at some very specific forms here. So the first form we're going to look at is the offer and compromise financial statement. So as we go into the 433A OIC and look at the actual tax form, based on all that data we just entered, we're going to notice some things right away here. Of course, the first part is just some real basic demographics, but first and foremost, we have his cash. So cash that he has on hand, cash that he has in his savings checking account, but it also allows you to take $1,000 off right off the top. So that's why it's not $3,100 and why it's only $2,100. Then we put in his stocks, and then there are some supplemental pages, but this is the IRA and the 401k. So we have various assets in here. In the case of his vehicle, because it has an $11,500 market value, even after we take our 80% quick sale value, the $9,200 value left, well, we only get one exemption for auto of $3,450. So it certainly doesn't shave that whole thing off. So we end up still with $5,750 for vehicle equity. So if you're considering his investments and his vehicle and his cash all together, he has asset value of $12,650. The next thing we have to consider is those income and expenses. And normally this section is for business assets and business expenses, etc., but we don't have any of those items. What we do have in his case is we have some income that comes from his wages. So he has basically $5,417, and then he has a little bit of some interest coming in. It's nothing exciting per month, but his $5,400.27 income, we have to try to see how much gets offset against the expenses. Now, in the case of all his expenses, remember, we get what he's spending. We don't get the whole $1,600 that we wished we had. So after we add up all these, we get $4,165. So he has leftover income each month, $1,262 a month. So if we look at our minimum offer, we end up with taking our $1,262 times 12, because our minimum offer, doing a lump sum payment, we have to multiply by 12. If we try to spread it out over more time, you can see that number is going to be a much bigger number because we have to multiply by 24. So in this case, we end up with $15,000 of income available added with our number, if you remember from before, $12,650, and this offer would be $27,000. So as we look at just one more form and kind of look at how that would work on the 656 if we were done and we said, you know what, Jack, this is everything you gave us, here's the amount of your offer, we would end up with a 656, which is, honestly, it's more of a contract anyway. But what the offer would look like in this case is we go in and say, yes, these are the years we're covering. He makes too much to meet this low income certification. So it's on the offer form, but our particular taxpayer does not qualify. And we have to show, what are we offering? So if you remember from the other form, $27,000, to do a lump sum offer, he has to pay 20% down. So $5,559 he would have to write a check for just to submit the offer. Then the remaining balance, the $22,000 left over, we would be recommending that he paid $4,447 a month. That's for every month, each month after the offer is accepted. So that basically is the total offer amount that there would be for our first example is $27,000. Now, in light of everything, that really is not too bad of a start. It could be that if you just took everything right off the surface, everything that Jack gave you, this would be the offer you came up with, because you're basically just inputting it right from there. But what I'm going to tell you is that you really haven't earned your pay yet. There's a lot more that you can do with this information than just what's presented on the surface. This could be very similar to if Jack took his own information and input it. He would have a similar offer. Now, this still is not that it's all that bad. So we'll just do a real quick recap off of this and what his result is. So as we look at what the results are of a lump sum offer, $27,794. So still a great savings. Remember, he owes $100,000. So this would be a savings of $72,206. Really not too bad to start with. But we're still not done. And as we look at the reason I didn't really use the periodic payment offers because of that leftover income and multiplied by 12, you can see how much of a jump that it would make into our offer. The periodic payment offer, if we stretched it out over 24 months, would be $42,938. And that would be a savings of $57,062. So for the purposes of my examples, I'm going to presume that he's going to be able to somehow come up with that $4,400 a month and that we would be doing a lump sum offer.